Hey, it's Scott Garlis at Stansberry Research. We are here at the 2019 Alliance Conference. I am with Nomi Prinz. She is author of Collusion, How Central Banks Rig the World. Thank you very much for being here.
Thank you so much for having me.
Certainly. First question. What would you view as a correct exit plan for global central banks?
Oh, that's an awesome question. How do we get to the right exit plan? So a lot of things that central banks did kind of have to be undone or at least mitigated, right? So one of the major things that happened was a tremendous amount of debt. Corporate debt, public debt, consumer debt throughout the world, and that's still growing because rates have been so cheap and because the quantitative easing has progressed for so long to buy that debt or some of that debt, not all of it. I think we need to dial that down. I think that there needs to be a structural sort of strategy in place to actually dial down debt, because otherwise you just kind of keep on printing money and debt continues to accumulate, and at some point that debt has to be repaid, whether by governments, corporations, or individuals. So I think we need to really develop a strong plan to some of that debt actually needs to be canceled, some of that debt needs to be restructured in a way that allows it to be paid down, an actual principal also paid down, and some of it needs to be managed so that it gets paid down over a decent amount of time and not pushed forward or grown forever. So that's going to be a big part of it. And also the idea that there can be this ongoing continuation of cheap money has to ultimately go away. There has to be things that are real growth-oriented projects, whether that's infrastructure, whether that's green infrastructure, whatever it might be, that investors have the opportunity to invest in the future, receive a return which has to be higher than zero or close to zero, and that central banks have to basically back off and allow for that to happen and actually not continue to reduce rates to zero and negative forever.
It's kind of scary that we've tried the experiment of backing out of this, and so far it hasn't worked out very well.
Because there wasn't a solution, and that's the problem. And you could see this happening. I actually wrote about this. It's one thing to say, all right, we're going to raise rates, which is kind of what happened, right? The Fed moved into a somewhat more hawkish phase from the end of 2015, stopped immediately until the end of 2016, because that didn't work out the first time with just a quarter of a point rise in rates in December 2015. It took a year to get another quarter of a point. And then in the couple of years since then, there wasn't a replacement. So the problem was that the global economy is slowing down. There's a lot of volatility coming in from a lot of different places. Adding on to that is political uncertainty, trade wars, geopolitical uncertainty, oil uncertainty, Middle East tensions, and you have this whole gamut of other parameters that have come in while rates are being raised with no plan as to how to basically take that extra interest income and use it to allow people to invest and to have a strategy to repay debt and a strategy for real growth. It was just sort of like, we'll raise rates, but we won't even have a PR plan to say, look, hey, you know why it's great to raise rates? Because that means pension funds can continue to be funded and life insurance plans can continue to be funded and infrastructure can continue to be grown, and we don't have to raise taxes as much because we're actually allowing interest to be paid on the long term. And so that helps the budgets of governments. Zero of that happened for a lot of political and a lot of just lack of foresight kind of reasons, but that's why we had negative impact from that. So by the time we got to December of 2018, the Fed was like, all right, well, that was one too many, turned around, went dovish, and within the last 8-9 months of this year, every central bank has re-gone into major dovish mode. And other central banks that weren't there to begin with, like peripheral countries, Egypt, Sri Lanka, Hong Kong, Saudi Arabia, Russia, etc., are now on that cheaper money bandwagon. And that's going to cause a lot of inflation for those countries and real hurt for real people on the ground. So the problem was there was no ultimate exit plan in general. There was just a rising of rates, and now there's a reduction of rates, and there's still no exit plan.
Excellent point. What would global financial markets look like today if the major central banks hadn't flooded the system with money in 2008?
See, I think they could potentially look exactly like they look like, but in an organic manner. What happened was we have had markets inflated. They have been distorted by what has been about $22 trillion worth of kind of fictitious, well, fabricated seed capital from the major central banks onto the financial systems into where that money could go most quickly, which was stocks, which was bonds, which is why spreads have tightened. Junk bonds are almost giving the same interest as really high quality corporate or government bonds, and all of this has been because there's been cheap money in the system. Had that not happened, had there been a situation where, let's say, a couple more banks were allowed to fail because as I like to say, shit happens. And there wasn't as much money thrown into the system from the collusion or the coordination of the major central banks at the time in 2008, 2009, and so forth. There would have had to be an organic recalibration of where markets were. And that could have meant that companies had to have better growth plans, that individuals couldn't take on as much debt because banks weren't trying to get it cheaply and basically stick it on to other people. Governments wouldn't have necessarily issued as much debt because it would have been more expensive to do so because rates would have been higher. Same thing with corporations. So what we could have had is a healthier system with less debt in it, whereby investors could have had the opportunity to basically invest real capital into those opportunities and do it in a way that actually provided them returns without this distortion of returns. So we could very likely be right where we are right now, but in a less precarious position.
Yeah, and interesting that if some of these banks that were way over levered had gone down, it seems like others, to your point, would have popped up in their place, and the natural cycle would have probably, we'd be in a, like you said, growth would be in a much better spot right now.
Well, exactly. Banks have failed in the past. You know, the thing that happened with the financial crisis was a couple of them failed around the same time, and not even really. Bear Stearns failed in March 2008, Lehman Brothers, of course, in September 2008, and there was this tottering on the edge of Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, which says they weren't tottering, but they were. Bank of America and Wells Fargo, both those to a lesser extent because they were less leveraged in options and other types of products. And they did get this deluge of money and this availability of additional money in terms of QE throughout the years, which allowed them to delever. Because, of course, you can delever if somebody is basically giving you money. It's like you're dumping water out of the cup and someone's filling the cup stays full. It doesn't mean that you really did anything but receive that extra water, which is what they did from the Federal Reserve and other major central banks. So in a way, they allowed themselves to be somewhat delevered. Well, they haven't changed the policies or the practices that allow them to get levered up to begin with. So right now, for example, a lot of mortgages that they re-put on their books are now continuing to go back into default land. CLOs, loan obligations, money that they've gotten cheap and lent on to corporations are starting to show signs of a fracturing of delinquencies of default. So they're kind of in a similar position. They've just been whitewashed by all of this extra money.
It's scary.
Yeah.
And then lastly, how did your history in banking shape you as an investor?
Well, it allowed me to do a couple of things. One is I was in banking as a strategist, as an analyst. I ran analytics teams. I built models. I hired really smart people to build models and to look at different types of products and different types of geographical locations throughout my career in banking. So starting at Chase, in terms of looking at portfolio allocations and what kinds of factors like currencies or interest rate movements would impact those. Going on to Lehman Brothers and modeling options and how they looked relative to bonds and so forth. And then I just ran an entire group at Bear Stearns in London where we looked at every kind of esoteric structure that was being created at the time, CDOs, which were at the crux of the financial crisis and so forth. And then to Goldman where I was doing a similar thing with credit derivatives and other types of products, and also providing investment advice and portfolio analysis advice and trade ideas to our customers, institutional investors. And so what that showed me over the years was to always analyze the downside, whether that was in the market, whether that was in a transaction, whether that was in a trade, whether that was in a reallocation of a portfolio, because if you didn't understand what your risk was, you were in danger. And so one of the things that I always put into my models, which wasn't necessarily the standard in Wall Street, this is why I was different. This is why I ultimately left, because it wasn't something that banks wanted their customers to know. Hey, by the way, if you do this transaction, you'll lose a shit ton of money. No one wants to know that. But I thought it was very important. So one of the things I learned from the experience of being through multiple crises, like long-term capital, like various currency crises in Asia and so forth throughout my career as I was working with institutional investors throughout the world, governments, central banks, and all sorts of pension funds, insurance companies, everything throughout the world, is that you have to be careful. You can make money, but you have to understand the risk. And so what I've done in terms of repositioning that to what I write about as a journalist, as an author, in terms of my own trading or any trade recommendations that I make, is that you have to always understand where your risks are and at least think through, if not solve, what your position will be if those risks occur. And you always have to be ready, and you have to have some sense of analyzing them, so at least you don't know everything, but you know that you can navigate if you need to, at least somewhat.
It seems like whenever the market sells off, you always hear about people not being prepared, basically to your point.
Yeah, and you can make money in a sell-off, but that, yes, that is the idea of being prepared, and not being emotionally attached to your trades or some of your investments, because the more you're prepared, the more confident you are that if things happen, you can ride them out because you've quantified what you need to do in order to be able to facilitate that, and also because you're just more confident in general because you know more. You know, the more you are aware, you can't control what happens, but the more that you are aware, the more that you can analyze, the more that you can understand that you can't be in control. Actually, the better you are as an investor and as a trader.
Agreed.
Yes.
Thank you for your time.
Thank you.
Thanks for watching, and stay tuned for more updates.